All right, enough of the bad trades. Let me show you actually a very exciting good trade. And when I mean exciting, I mean it was quite an experience to trade it. And I realize most of the trading coaches, they preach, don't let your emotions get in the way. And for the most part, that is a correct statement. However, you are a human being. You will never be able to turn off your emotions. And that's absolutely also not the task at hand. The task at hand is to be a master of your emotions so that you actually can use them to your advantage, which means is that when the situation allows it, you can assess it quickly and you can take risks as you feel excited about taking them without being reckless. You're not afraid. You don't shy away, and any of the, let's just say, emotional instabilities. But on the contrary, you know exactly when to strike. When the iron is hot, you beat that motherfucker. Okay? So let me show you a fantastic trade here that I really, really enjoyed. Again, let me move away my beautiful face. This was a beautiful trade on the Kiwi dollar. And you can see boom, we hit the take profit in full. That was a really, really exciting trade. And why was it exciting exactly? Typically, the strategy is a trend continuation strategy, right? So we look for structures on the bigger time frames. We align those with the structures on the lower time frames. We look for specific zones, right? Important zones that the market shows to us, depending on how many times it tested these zones, right? And then we look for strategic entries to run those, and we look for a 1 to 2 risk reward. That's, in a nutshell, the strategy. Keep it simple, stupid. In this case, we are still applying the same strategy, but I have adapted it in the sense that I'm going on an even smaller time frame and I'm adapting it to a reversal. Why am I doing it on a reversal? Because, and I'll show you that in a moment, the opportunity was there and I decided to take a risk, a calculated risk again. I'm not going to put more risk on a trade. I'm not going to add to a loser, and I'm not going to lose all the other structures that I have in place for my strategy. I'm just applying the exact same strategy on a little bit of a different, let's just say, perspective, even though it's exactly the same. And that's sort of the thing that you learn as you mature in the market, as you mature as a trader, as a person, with your emotions, with your results, with your strategy, with your abilities, with your data, all of these things. You understand your statistical edge and all of these, let's just say, facts. Then you are so much better at taking discretionary decisions, meaning decisions in the heat of the moment that you alone decide whether you want to take them, you're capable of taking them or not. And that is a skill that you have to learn with experience. It's not something that you can just read in a book about or copy from someone. Got it? So let's move forward. What do we have here? So first of all, weekly structure. We see the market was more or less sideways, but then we had a heavy sell-off, right, on a weekly structure. Had a little bit of consolidation on this support level here, but then boom, dropped even below the next support level and then reached that lowest level that we saw here some months before as well. And that's actually the interesting part here. So bearish, clearly. Then on a daily, we also see clearly bearish, right? We saw the market trying to go up and then it completely failed. This is the mother of all bearish structures. There's literally not even a little bit of bullishness or reversal in here. And then we saw sort of a consolidation down here at this level that I just mentioned on the weekly. So the first time we see a little bit of a try of the market to, not drop any further was here. Because you can see this consolidation, it also failed and then ran back down. So that risk was more or less here. And then we got still supported on that important level. And why is this level important? So first of all, we also see on the 4-hour structure that the market tried, after we went down, tried to break that structure up here, could not. But then it went down, it broke that structure, but it came back immediately. And then we formed a new high here, right? Basically from that structure, this is a new high, higher than this one. And then this structure didn't go back down again. And it was on this zone. So what I was looking for was to trade a quick reversal. And why would I choose this area for a reversal in the first place? And this is the reason. Because sometimes, or some assets have a certain type of behavior. And the Kiwi dollar, particularly, as you can see here, it drops massively and it comes back massively. So you have like this basketball effect, if you want, that this pair likes to show. Big move down, big move down. It has these V-shaped moves on a bigger time frame. Mind you, this is the weekly. They happen. So it's part of the character of this pair. And again, as you become a more professional trader, you have your specific markets that you just have more of an understanding about simply because you've been watching and trading them more and more and more, time and time again. You're collecting data on them. You've had successful trades on them, en masse, and then you actually are able to say like, you know what? I like this. Because I'm not going to trade this kind of V-shaped recovery over several weeks, but is it probable that this is going to try to reattempt the small next resistance level? Absolutely. I think the probability here is quite constructive, enough for me to take that risk. And that's essentially what I did. So why do zones matter? Because you can see even going further back, that even a couple years back, that this zone was a V-shaped zone, right? Like, so this type, whenever the price really tanked that much, let's not forget, this is where currencies are different to stocks. Like when a stock just goes down because the company fails, there is no floor to that. But currencies, they're bound to economies, countries, commerce, like there's real economies going on between these countries. So for the Kiwi to go to zero versus the US dollar, let's just say, that chance is, next to zero. Because New Zealand is a country of the Western Bloc with a proper economy. So for this to have some merit is because, you have currency pairs, right? You have the dynamics of two pairs, two economic areas against each other. So this is why zones matter. And this is why you define the zones. And this is why you gotta look left on the chart, especially on the bigger structures. This will, basically show you possibilities like that. So what did we do next? So we started to analyze, is there any signs of reversal on the daily? First of all, ignore this one. This is too high, too far away. I'm not going to trade that much. We were talking about the first zone, this one, right? Like this little bit after such a big drop, like this kind of bounce back, only a little bit, right? And we can see on the daily, we made the lowest low here, but after that, we had some recovery and the new daily structure did not go lower. So that is, first of all, like we use our normal analysis method, shows us here, okay, this looks interesting. And then we go on the 4-hour chart. And the 4-hour, you see like I'm applying the exact same principles. Absolutely nothing to a normal trend continuation trade. So you can see also here, you had these support areas, right? The price failed at the level where we are targeting our take profit. And then it came back down and it held here. It broke that structure down. It was supported on this, let's just say, multi-year support, came back up and then traded again on this support, made a new high, and then actually also held the support, came back down, but didn't revisit that low. So that for me is essentially a trend continuation structure on a more micro level, on a smaller time frame. So that's why my interest was, if we break that level here, I'm going to go in market and just target the trade back up here. Okay? And okay, you could argue even our dynamic resistances, basically my moving averages, we're trading below the weekly, we're trading below the daily, we're trading below the 4-hour. So there's every reason to assume that bearishness will continue. But that multi-year support level and what I just explained about the dynamics of currencies is where the opportunity was. And this is why I was willing to apply my same K.I.S.S principle, but on a reversal. Okay? So what happened next? We zoomed into the 1-hour chart. right? Because now we're looking for a smaller move on a reversal type of situation. We need to zoom in. We need to go in on a smaller time frame in comparison to what we usually do. But we apply the same principle. So we look, where are the important zones on the 1 hour? And you can see again, how do we define these zones? By how many times they have been tested. So you can see here, support, it broke down, resistance, it came back up, and then we have this support, and then even as we broke this support, we were held again by this support resistance structure, and now we saw the reversal. So that is, for me, okay, we might now be in for that bounce back, that little push up. Again, this is not a big move, right? We're looking here like 60 pips or something. It's not a big move, not at all. And this is then also where you need to define your targeted range. Remember, like, what you see here now in big charts, this is just a tiny range on the bigger time frame, okay? So you have to understand that I'm really not targeting that much. This isn't that big of a move that needs to happen, right? So that's why I'm willing, and again, I'm cutting my risk at this support level that has been an important point of interest before. So I'm not taking any stupid risks or let the trade go against me far and add and any of that. This is a quick attempt of a reversal based on all the analysis and explanations that I just have given you, following the exact same K.I.S.S principle, okay? The statistical edge principle. And you could see now what happened is that here the price failed, it came back down in this support area, and then it actually broke this, right? It went higher, and this is where I entered market, right here, boom. And then, the market came against me first, but this is why I define my risk. I don't get nervous, I entered the trade, and now the market immediately turned against me. So, an inexperienced trader, I would say like, oh, fuck, what's going on? Maybe I should cut it, and they get antsy, and this is where the bad part of emotions play in if you don't have a plan, Come up with a good plan, and then trade your plan. Plan your trade, trade your plan. Very, very simple. But not too long after that, the trade actually went up, almost hit RTP, came back down again, right? But I have my trade management rules. I will not interfere with that at this level. Maybe if it came back down and in fact, broke structure, then I would look at a break-even exit, things like that. So maybe I could do actually a video on the trade management part a little bit more, but I've explained it also in other videos. But nonetheless, you could see eventually we hit the take profit and then actually it went back down again. By the way, the interesting part is, but I don't have this in this video now, after that, the structure of the bigger time frames also started to shift into a more bullish scenario. So actually, the Kiwi dollar started to then see reversals on bigger time frames following this one. But we took a quick trade, we took the reversal, we followed our exact same principles, and we made nice money on this trade, on the track record account. All publicly verified, available for you to follow and see the result. So what's the learning here? The learning is that watch very important zones. Very important zones are on big time frames usually, and where you have seen massive reactions, and map them out, understand where they exist, and then also pay attention to them as they come into play, because they may shift the dynamic of what's going on. Assuming a price going further down on a level that has been held multiple years when there's no economic shift between the two economic areas is just foolish. Euro dollar is a different conversation at the moment. Why? Because the economy in Europe has been struggling. It's politically struggling. And the US is the opposite of that. So that's why you've seen levels break and break and break and break. But if there is nothing fundamentally supporting that, you should expect that currencies trade within ranges that are going to go up and down and up and down. And in this one, as it was a multi-year support that has held over many years, the probability for a small trade reversal there was just high. So I watched this important zone and then I adapted my exact same strategy dynamically to that situation and took money home. That's how trading works. If you like this video, if you like content like that, please leave me a comment. Anything you would like me to cover, write it down, share it with your friends. I'd really like to have more people understand the reality of trading. No influencer, get rich quick, whatever, you know what I mean. This is actual trading. And you know what? Everyone can do it. You just got to lose your wrong expectations and your wrong behavior, act properly, learn it the right way, and live an independent, rich life. Thank you very much. I'll see you on the next video.